No matter what the year is, these are still a fantastic set of results. Yes, we did have a downturn in the final quarter, but even with the slowdown in the final quarter, we still managed to produce at magnificent margins. And so we, even with this downturn, very happy with the results that we've achieved.
Yeah, from the statement that you sent to the stock exchange, we saw you're talking about a tale of two halves, isn't it? You have a fantastic first half and then you have a second half so much under pressure.
Godfrey, I think this was a tale of 3 quarters with really fantastic and one final quarter that was reduced. But again, the message was for the final quarter, notwithstanding the really big difficulties that we had with the downturn in the market, we still managed to produce significant profits for the final quarter.
Tell us where the difficulties are.
The difficulties are largely coming from the global economic slowdown. The global economic slowdown has affected demand in our industry, as demand reductions have come from steel reductions. And so we're seeing, particularly from Europe and to a lesser extent from Japan, we're seeing a reduction in the demand for steel and therefore a reduction in the demand for iron ore.
Yeah.
So that's largely where it's coming from. We are still able to produce and sell into China above our contractual volumes, and Korea is still taking their contractual volumes from us.
Right. You came in at the upper end of the estimate that you gave in December. Was that difficult to achieve?
I think we still had a really good final quarter. There will be some analysts that will be disappointed with some of the loss of earnings in the final quarter.
Sure.
But it was still on the upper end of the range that we've gave, and that was because of our really, notwithstanding the downturn, still a good quarter.
Sure.
In the final quarter.
Which was your most difficult market?
Europe is our most difficult market.
Europe
is where the biggest reductions are coming from.
I see in the statement you make reference to the fact that you're trying to make up for what you've lost in Europe and try and see if you can make it up in China as well as Japan as well.
We are making up our contractual volumes, so we're selling all our contractual volumes in Korea
China.
and China.
Okay.
And China, we're making up some of the loss in contractual volumes that we're not selling into Europe and into Korea, into Japan. So from those 2 markets, we are able to sell some of that volume in excess of our contractual volumes in China.
Right. Now, let's talk about the difficulties that you're facing. But even maybe before we even go to that, I looked at your numbers and I saw you've got your operating margin up. I think 62%, was it?
Operating margins up 63%.
63% from 52% last year. Of course, as you say, the first 3 quarters were excellent, so they made up for a bad last quarter. But how reflective of the whole business is that number?
Look, this is one of the very important things to remember about our business. It is a very strong cash generative business. The operating margins at 63% are a fantastic operating margin to have.
Absolutely.
Even if let's just take an example. At the moment, we're producing at about $35 a ton. Landed cost into China. The current spot market, which we're selling above, our contractual prices are above the spot market.
Okay.
Even if we were to sell at the spot market of currently $80 a ton, this would indicate greater than 50% margin. So even the current circumstances that we have in excess of a 50% margin. And this is a very important thing to remember about Kumba's business. Notwithstanding the current market difficulties, it's still a really good cash generative business with a good margin.
But Chris, those prices are going to come under pressure, isn't it? Because you're talking about the decline in demand that you experienced in the last quarter. Do you expect to be able to maintain those prices in this quarter, in the quarters coming?
You'll recall that the iron ore year ends at the end of March. So this is normally the season where there's negotiation now in this quarter as to where the final prices will be.
Right.
I think there's a consensus that the prices will reduce. But for that reason, when I quoted the margin that we have,
Sure.
I didn't talk about the current market, the current price settlement that we have. I spoke about where the current spot market is. So the current spot market for fines is at over $80 a ton.
Okay.
We're producing just over $13 a ton, but landing it into China with all-inclusive costs of about $35 to $40 at the outside.
Okay.
That would still indicate, even if we were to get a price reduction equivalent to where the spot market is today, we'd still see a margin in this business of over 50%.
Right. What's your expectation of prices going forward? You've just said they are likely to come under pressure. Yeah.
Look, there is an expectation that the prices will come under pressure. If traditionally the settlements have been reached at around the spot market level, if we were to settle today, and assuming that the history plays out again this year, that the settlements are normally at around about the spot market, if that stays the same, then we're anticipating for fines about a 10 to 20% reduction in price.
Right. And your statement refers to the fact that you expect to increase production by 10%. Where are you expecting the growth to come from, given all these pressures around?
Yeah, that 10% in production growth is what we're expecting for 2009.
Right.
And that growth is coming from the continued ramp-up of the jig operation. So the jig plant itself achieved just under 5 million tonnes for last year.
Right.
And we're expecting all of the increase, that 10%, we're expecting that to come from the jig plant itself.
At the same time, you are maintaining your capital expenditure, or are you? Are you relooking at your capital expenditure given now the changed circumstances in the global economy?
Yeah, really good question, Godfrey. I mean, we did at the end of 2008 announce that we have critically reviewed our capital expenditure. The result of that review was that we were much more careful about where we were spending our capital,
sure,
but we have not cut back on the capital for our Sishen expansion project.
Right.
So all of the capital that we're needing to spend on the stay in business continues, but with a much sharper focus on what we're spending and how we're spending it.
Right.
But for our growth projects going forward, on our big next phase of expansion, 2012 is our Sishen South project. By then we expect this market to have returned,
right,
and we don't want to jeopardize our business to take the full benefit of when this market turns around. So we continue with our expansion plans and not cutting back capital on those expansion plans.
Right. So at Kumba Iron Ore, at least, no one is talking about retrenchments and job cuts.
We're certainly not talking about that yet. Clearly, we're watching the space with the market, but at the moment we are planning for job increases, particularly around our Sishen South project.
Right. One negative, if I may call it that, was I saw costs up 24% during the year. Was there a particular reason why they were up so sharply? Double the inflation rate?
Yes, I mean, you clearly need to look at the main drivers of our business. If you have a look at the Sishen South, the Sishen unit cost itself, on a like-for-like basis for 2007 to 2008, these costs were up 30%. 24% of that 30%. So the majority of that cost came from two items alone. It came from inflation and it came from the fuel costs. You'll recall that the fuel costs went up almost double. And we're spending, we use 60 million litres of fuel in our business at Sishen Mine, and that's predominantly where the costs have come from. So I think you could say that the majority of these costs were really outside the control of management and really were influenced by the world market factors.
Yeah.
So we are expecting now, with this reduction in fuel price, to see certainly one of those cost drivers to be reduced somewhat.
Right. Now, you've answered part of the question I had. Now, the other question that I had related to that is the issue around how much was added by the reduction in power supplies that we saw at the beginning of 2008 to your company's costs.
Yeah, in our company, this is now one of the benefits. So although I've just spoken to you about one of, we got a lot of costs from the fuel increases, but in our business, we only use 2% of our overall costs come from electricity.
Okay.
So the fact right in the beginning, we're not a big electricity user. In the beginning of the year, when we saw these pressures from the electricity crisis, we did manage to, we had to shut off some power. It had a small impact on costs, but when we shut off power, what it means is that all we do is we use more diesel. So we shut off the pantograph systems that help the trucks run more efficiently and faster, and we just use more fuel. And so it did have some cost impact, but it didn't impact our business as a result.